Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein with your Agriculture Update for this Monday. This is the 27th of November, 2017, time about 4:55 p.m. Central Standard Time. Normally I have the boards with the prices behind me, but as you can see, they're cleared out as the markets get ready to reopen in 5 minutes as I'm talking. I'm just plain late today. Cannot give you reasons why, it's just how it is. If you look at the 18-week moving average of closes on this weekly area chart of just closing prices, you can see how the market shifted in September to staying over that, and so far it's done a nice job of it. What it's lacking is a punch to the upside. You haven't been able to get over this high that you made quite a while ago now, and you can come here and see the date that I'm talking. That high close was made on October 13th. So here we are approximately 2 weeks later, and the market's unable to have punched through that number. In fairness, it hasn't broken through the average, but it's not able to get anything really going. When we go to a daily area chart of closes, you've gone from 967 3/4 to 997 1/4. The thrust momentum is upwards. I don't think you'd want to close under Friday's low, which was 993 1/4. It could give you a pattern where you want to pull back towards this 18-day average of closes. So something I'm looking at. That's all that I could say with it. In looking at the momentum today, the one obvious thing is you have what's called an outside day up. On an outside day up, I have a theory, doesn't mean that everybody else does, it's my own, that low should not be taken out on the Tuesday or Wednesday trade session. If it is, it means that this attempt at the rally today is a failure, a trap for the bulls, and the market often likes to pull back to key support areas. When I look at the swing lines, I can make an argument that, and by the way, this is a chart without swing lines, here they are. And they're showing you've got a pattern of higher lows and higher highs, and the only thing that can break that pattern right now is getting under 983. That doesn't mean the pattern can't change tomorrow. If the market were not to take out today's highs and just slip back, that pattern stays in place as it is. Where's support? It's above that number at 988. So in essence, even if you have and take out today's low as a trap, the support for the market is 988, about 8 cents away from here. You have not been able on a current move to get up here and challenge again the upper Bollinger Band. Each time we have recently, we have ended up failing miserably and pulling right back to that 18-day average, and that turned out to be a high. Now, we haven't done it yet. If the market continues up, will that be the pattern we should look for becomes the question. And the fact that you're not overbought, and you weren't overbought here when it happened, but you were here and back here, you can see how that works, doesn't give me much of an edge. So let me put it this way. The trend is up. You still have the swing line up with higher lows, higher highs. The momentum is up and the bias is up since you're over the 18-day average. On pullbacks, I would expect to see professionals support the market unless it gets under 983. In the meal market, a similar pattern, but the big difference is you closed over the upper Bollinger Band. And if you look at today's close over that, and we go back to Friday, Friday's close in the market was 325.90. It closed over the upper Bollinger Band by 1 tick, but it's a close over it. If we go to the day before that, I did that wrong, you closed over it. So it's 3 days in a row that you've closed over the upper Bollinger Band. 5% of the time, you'll close over or under a Bollinger Band. I have a rule of thumb. I've made it up myself over many, decades now. And it's that, as a rule of thumb, you can count each one of these days when they do this as a consecutive pattern is one of those percentage points. So I say there's a 2% chance tomorrow of the market closing over the upper Bollinger Band. I've seen it go 7. But when you're trading and you understand the percentages, it changes your attitude. Should I be chasing a market or trying to buy it at these current levels? I'll let you do the rest of the math for yourself. That's what I've discovered. When I look at January soybean oil, lower highs, lower low, outside day down, into oversold territory and hit the lower Bollinger Band. I would not be surprised at all if the pros were covering shorts today. There's no reason to be a bull, but every time you've hit this lower Bollinger Band, you've gotten a bounce. Why should it differ? That's the key. In the corn market, another failure against this 18-day average of closes. And it didn't give you much of a pattern. You've got a higher high and a lower low. Can't do anything with that. Wheat, on the other hand, has broken through the lower Bollinger Band. The big question is, we've been in something of a downtrend, but notice the narrowness of the Bollinger Bands. They're not widening out at all. It's almost like the market goes, okay, let's go down for another low, and then you end up bouncing back to that 18-day average. And I have no reason to believe that anything's changed here. You're very oversold. Without doubt, the bias is down. You're not trending. You have a higher high and a lower low. The market just doesn't give you a lot of follow-through. And because of the narrow bands, if you're a trader that believes in selling the 18-day average and buying back against the Bollinger Band is a concept, that's all I'm saying, well, you're not getting much there. It's just a market that's lost a lot of its volatility. In the sugar market, we're first overbought. You've got no trend, lower and low, higher high. You have upside bias. Support, I would look back at the 18-day average, 14.95, about 45 points lower, and that's about all you can say about it. Coffee market. Coffee tried to get something going today, and where did it rally to? If you take a look back here, one of the things I teach is when you get under a lower Bollinger Band or above it, I think traders are using those Bollinger Bands as get-me-out moments. Not all the time. Eventually you break out of sideways action and you might be left in the dust. But in this case, now you bounced away. If it continues bouncing, the 18-day average becomes the potential resistance. You hit that today and you stalled out. Now the trend of the market is defined by the swing lines up, higher lows, higher highs. It's countered by the fact you closed under the 18-day average. You go neutral with that, and momentum has gone flat in the market. In the cocoa market, I was surprised to get the follow-through today. I thought, frankly, the market was going to stall here and try to get back to the 18-day average due to, in part, its oversold condition. It didn't do any of that. Lower highs, lower lows, bear trend, oversold. Key support 2038 to 2030, the combination of the 100-day average and the lower Bollinger Band. And in the cotton, was this a near-term top that was made? Now, why do I say that? Remember that little lecture I just gave you on Bollinger Bands? 1 day, 2 days, over the upper Bollinger Band. This day you closed under it. So here, the market pulls back and just gets under that. But it's also in a market that's staying overbought, not even trying to convert its stochastic study to getting both numbers over 80. So because it's not trending, the question is this going to prove to be a big enough resistance point to get back to the 18-day average, or can it build on something here to embed? It's done nothing to convince me of anything. In the cattle market, you ended a phase of the downtrend when you got over today this high here. It put up the swing line as higher lows and higher highs. It's not in an uptrend because you're under the 18-day average, so the swing line counters itself with the downside bias. Momentum did turn up. It never did embed. Well, all I can say is it's a market that's trying to put on a rally, and that's about it. Same in the feeder cattle. While the swing line is up, the 18-day average is facing you right there with a lot of resistance at 155.90. Now, in the hog market, you closed up at 70.10 over the 18-day average. One of the things that I teach in my charting course, and you might want to go onto our website and take a look at the charting course, I teach you how to measure risk with the swing line. And if you think about this, if you were to be a buyer here, if your risk is 66.85, one tick under that low to keep the swing line pattern live. Do you really want to risk in a trade like that 300 and some odd points. It's over $1,200 a contract. I think money management is almost as important as any technical tool you can find. So one of the tools that I think is even better than that is the slow stochastic, but that's another story, and I explain it in the charting course. As you can see, we're reopening right now in these markets, and this is how the fresh look at them is at this point in time. We'll see where it's all going to carry. We'll see if you get followed through one way or the other. With the tax bill front and center, that becomes the issue. Now, for those of you, especially grain traders, one of the features that our firm does is they write a lot using price counts in grains. And the reason is they adapt, for whatever reason, really nicely to it. We teach you via two PDFs. First, what is a price count, how to apply it. We have videos that show it, and we have the charting software that'll do it. So if you're looking to figure out, once a trend sets in, where a market might carry based on a technical tool, this is one of the tools that does it. As you can see here, you set up a pattern of a high, and then we start measuring the lows. Here we have a low pattern. The price count is activated, and we start getting to the upper counts. We teach you how to do all this, and we teach you the importance of it. I'm even going to be writing a special report on the weekends on price counts in the financial markets. How do you get this information? Call us. Go to our website. You can click right up here at any time if you're watching me on YouTube. Or underneath us, it says, click here for Ira's free information on a bunch of sites. Do so, and we'll put this in your hands. I'm Ira Epstein. You have a good day.